Well, hey everyone, Matt Walton with InsuranceNewsNet TV, bringing you our fresh, fast, fun, and informative discussion of the insurance industry. Your industry, even when I'm on vacation. Now that's service. All the news, views, highlights, and happenings, everything interesting and imported that matters to you. From right here in sunny Orlando, Florida, everyone's favorite state of retirement. And on that subject today, we're talking about the survival of the life insurance industry, which I'm sure will continue to live long and prosper, but we should cover ourselves just in case. These are the jokes on vacation. Now, many factors affect the viability of the sector, but none has been more important than interest rates. In the world of life insurance, all roads lead back to interest rates. And what a low road it's been. Think Death Valley. We're talking that valley you fly into when Luke, blew up the Death Star. That kind of low road. Until December 2016, the Federal Reserve had let its lending rate languish near zero. Now that I say that out loud, I don't even think zero is an actual rate, is it? But I digress. Even though the low rate was supposed to help the country heal from the worst recession since World War II, many have blamed the Fed's sustained low rate for the economy's painfully slow recovery. Aside from the housing bubble, banks short of liquidity, drop in world trade. Oh, and peak oil, but other than that, who wouldn't blame low lending rates, right? Those rates certainly have played havoc with yield on safe investments, though, and of course the industries that depend on them, insurance being one of those industries, your industry, where many companies haven't been able to make the spread they need to cover their obligations and make money. Although we are talking about the Fed funds rate, it has an indirect relationship to insurance company investments. The most important rate is the yield from the 10-year Treasury note, which is the primary investment vehicle. And things have been bad for the Treasury note. How bad? Historically bad. When the yield dropped below 1.4% in July 2016, it was the lowest since George Washington could have paid for one in 1790. And his face was on the damn thing. The perennially low yield not only means that companies can't offer competitive rates, but also that old policies are coming home to roost. See him back there? Decades ago, in the higher interest world, carriers could offer universal life contracts with a guaranteed annual interest rate of up to 5%, because the insurers can make up to 10% of the money. Companies are now struggling under the weight of those rates. No! Clients are still holding on to those policies. That's because another big surprise was the ever-lengthening longevity. People keep living and living, and living and living and living. Now, it's really good for people, but not so good for companies holding up their end for what is supposed to be permanent life insurance. So keep up the sun salutations and choke down those kale chips, everyone. But we, as the insurers, need to get more creative, or at least more flexible. With companies coming perilously close to paying out more than they receive, some have had to boldly go where no man wants to go. They are asking policyholders to pay more to keep their contracts. In some reported cases, insureds were given notice of premium increases up to 200% after decades of policy ownership. Clients in particular don't like that, and several have filed a lawsuit, as reported by the Wall Street Journal, which also said that the plaintiffs are seeking class action status. Yikes. The Treasury rate has risen from its historic low, but it's still not enough to sing happy days are here again. Although the Fed has promised more increases to its prime rate, it will still be uncomfortably close to zero. Oh, that is uncomfortably close to the sand trap. Well, the good news is that sheer terror is the mean stepfather of invention. Sheer terror has also led to two developments that have proven to increase sales: indexing and features such as LTC benefits. Indexing was a feature brought over from fixed indexed annuities. Indexed Universal Life, or IUL, works on the same principle, where you have a separate account within the product that tracks an index such as the S&P 500, then it delivers a percentage of the gain to the account. That has allowed for the alluring massage of combining the security of the UL with the potential upside of the indexed account, which clearly resonated with consumers. Like indexed annuities, IUL is a market leader, becoming 51% of the UL market by 2015, according to a Millman survey. That was up from 37% in 2012. Elaine Tumicki, Vice President of Insurance Product Research at LIMRA, pointed out that companies will need to be a lot more creative to become more relevant. 30% of American households have no insurance, according to a 2016 LIMRA report, and nearly half of households that are insured were undercovered by an average of $200,000. What's the point? You can keep your house but not enjoy life? Come on. As far as companies getting creativity right, Tumicki identified John Hancock's example with its Vitality product. It rewards policyholders for healthy living and gives them activity trackers to record their efforts. And shucks, I forgot my Fitbit today. Good thing, I'm on vacation. But she said insurers will still likely need to be more innovative with their products. She said, quote, "There is no silver bullet, no single solution that will fill the coverage gap. Instead, it will likely take a combination of new product ideas, new market approaches, and new distribution methods," end quote. A key innovation comes in the form of riders and other features. They are known to the public as hybrid policies. And not only are they helping with sales and consumers' needs, they're also getting a bit of love in the media. Accelerated death benefit riders used to pay when a terminal illness occurs. Now that has been expanded to include chronic illness, with 23% of all UL policies including them, and long-term care needs with 19%. That percentage is projected to explode. Who doesn't need a little long-term adjustment every once in a while, am I right? Ugh. According to a LIMRA survey of Americans' top retirement concerns, tying for number 2 were paying for long-term care and paying for medical expenses. A quarter of those surveyed said they would buy an LTC rider if they purchased life insurance. 40% of millennials said they would buy an LTC rider. Right, Miles?
Yeah.
See? So, although we started this segment discussing interest rates, it appears a simple Fed increase is not necessarily the answer to solving the insurance industry's problems, but rather, the more problems the industry can solve, the more success it will earn. This is Matt Walton with InsuranceNewsNet TV. Come on, everybody. Let's do this.
It's getting dark, too dark to see. I feel I'm knocking on heaven's door.
I got a game to play.
Knock,
This isn't even the
knock,
green. We should probably go. We should go to the course, right, Miles? All right. Good idea.
Knock, knock, knocking on heaven's door.
Oh, wait. Probably should have the
Knock,
camera,
knock,
right?
knocking on heaven's door.
Huh? Nope.
Feel like
Shanked it.
knock, knock, knocking on heaven's door. It's only 3 chords in the whole song. Now you make up some words. I'm at Lake Eola singing for you. I'm getting tired and I'm hungry too.
Get this man some food.
I need some gas for my car. Won't you put some cash in my jar?
Yeah.
Oh my God. I'm knocking on heaven's door.